me if this sounds familiar. You're tracking your favorite stock or crypto and you decide to enter a trade. But then you end up panicking at the worst possible time and exit for a loss because the price dips slightly below your entry, going against your expectations. Or the opposite happens. You refuse to exit a profitable trade because you're greedy for more profit. And the next thing you know, the price moves in the opposite direction, wiping out all your gains and putting your trade in the red. This is what we call an emotional trading. And it's one of the biggest sins you can commit when trading or investing. If left unchecked, it will wreak havoc on your portfolio. Every trader at some point in their journey goes through this. I'm no exception. In today's video, I'll cover two of the biggest emotions in trading, fear and greed, and share the mindset shift and techniques that help me overcome these hurdles and improve my own trading. I'll also present time-tested approaches to managing risk, practical tips for staying emotionally balanced, rule-based strategies to limit the trading roller coaster, and a personal example so you can see how it all comes together. Trading psychology is one of the most important things to master if you want to become a profitable trader. I also like to think that in trading or investing, risk management and trading psychology go hand in hand. In other words, if you can't control your emotions, you won't be able to manage risk properly in the market. You don't often see many people, especially on social media, talking about trading psychology. They usually focus on technicals and fundamental analysis, but keeping your emotions in check is just as important. When you're trading, every price tick can feel personal. This is a symptom of fear. Fear makes you hesitate to enter a perfectly valid setup. Then, when you finally see the potential trade working out, you think, why didn't I enter when my indicators told me to do so? Next, FOMO kicks in and you jump in after the price has already climbed. The next thing you see is a sharp correction, leaving you holding the bag. Fear can also cause traders to close their trades super early to avoid any loss, but then they end up missing out on bigger profits. Fear stems from uncertainty and the pain of losing money. Greed, on the other hand, is the opposite. It's when a trader stays in a profitable trade for too long without taking any gains, then sees the trade reverse and turn into a loss. Greed also makes traders ignore important exit signals because they are convinced that the trade will work out eventually. Greed comes from focusing too much on potential profits and ignoring risks. Another subtle sign of greed is entering new trades hastily, right after a big win, assuming the luck will continue. Recognizing this pattern early can prevent compounding losses down the road. As you can see, fear and greed can cloud our judgment in the market. So, how do we overcome these emotions and get back in control of our trade? The answer lies in mindset shift, one that changes how we approach every entry and exit. Changing your mindset can be really hard, especially if you're new to trading. One proven way to do it is by adopting a professional, rule-based approach. This means writing down your rules for when you enter a trade, when you exit, and how you cut losses if the market goes against you. Keep these rules visible on sticky notes attached to your monitor, for example. I did the same thing, and to this day, I still keep my rules in front of me. Now, here's the key. Make sure you follow these rules and never, ever deviate from them. In the early stages, while you're still learning to control your emotions, it's important to stick to them without any exception. By doing this, you're not just creating a plan, you're creating a structure. Not only helps you to stay disciplined, but it also removes the guesswork and prevents impulsive decisions, especially when emotions are running high. Over time, as you gain more experience, you can adjust and refine your rules to match your evolving trading style. The more you learn, the more rule-based system grows with you. But rules alone aren't enough. To truly protect your trades and manage emotions, you need to apply proper risk management techniques. Think of it like this. Having trading rules is like driving on a well-marked road, but without risk management, there are no guardrails. One sharp turn or a volatile market move, and you could end up off the track. Those guardrails keep you safe, helping your trades stay on course, even when the market gets rough. Risk management is a broad term, covering many things, but here I'm mainly referring to setting clear stop losses and profit targets before you even enter a trade. This way, you're prepared whether the trade goes in your favor or not. Another important technique is position size. If a trade makes you lose sleep at night, chances are you've taken on more risk than you can handle. Reducing your position size to something that aligns with your portfolio and risk tolerance will help you keep your emotions in check. Stick to these principles. Over time, you may find yourself refining or even even simplifying your rules as you figure out what truly works for you. And here's a quick tip. Create a pre-trade checklist. Before hitting that buy or sell button, ask yourself, does this trade follow my rules? Am I comfortable with the risk? Do I have a stop loss and profit target in place? Answering these questions makes it easier to stay disciplined and stick to your plan. We've already discussed a few risk management strategies that help keep emotions in check and improve profitability. But there's always room to grow, especially when it comes to managing risk over the long run. One great addition to these strategies is keeping a trading journal. This doesn't have to be anything fancy. Just log all your trade before and after you enter. Write down your mental state, emotions, and expectations. Record your stop loss, profit target, and the reason you're entering the trade. Then, once you exit, add the exit price. Note what went as expected and what caught you off guard. Also reflect on your mental state afterwards and think about what you could have done better. By consistently tracking this information and reviewing it regularly, you'll start to notice patterns. Often it becomes obvious pretty quickly where mistakes are happening or when emotions are clouding your judgment. This simple habit can lead to major improvements over time. Another important technique is taking breaks. I know, sounds simple, right? But if you're like me and spend most of the day glued to your screen from pre-market to close, it can start to wear you down. Trust me, constantly staring at charts isn't sustainable in the long run. Short breaks, even for just a few minutes, can help reset your focus. I also recommend stepping away from the markets completely for a full day or two from time to time, especially on low volume days. You would be surprised how much a little break can boost your mental clarity. Another strategy that I use when day trading is what I call the 3 strikes and out rule. It's very simple but incredibly effective. If you lose on 3 trades in a day, stop trading immediately. Shut down your platform, step away from your desk, and move on with your day. The small habit can prevent emotional decisions that often lead to even bigger losses. I highly recommend trying something like this to avoid overtrading and to stay disciplined. When emotions take over, it's easy to abandon your rules, whether that's ignoring stop losses or jumping into trades without a clear setup. After a loss, the urge to recover quickly can push you into impulsive trades, often without proper analysis. This response is driven more by frustration and impatience than solid market reasoning. By sticking to the 3 strikes and out rule, you significantly reduce the risk of revenge trading and avoid putting your account in jeopardy. Another great tool is paper trading. Most brokers offer demo accounts that let you trade the live markets with fake money. This is one of the best ways to gain experience without putting your capital at risk. It's incredibly useful for beginner traders or even more experienced traders who feel out of sync with the market. Paper trading lets you test strategies, refine entries and exits, and get a feel for how the market moves, all without the emotional weight of real money on the line. Backtesting goes hand in hand with paper trading. If you come up with a new trading strategy, I recommend testing it against the past market data. This lets you see how the strategy would have performed under different conditions. After that, take the strategy into paper trading to see how it holds up in the current market. One important thing to remember about backtesting is that just because something worked in the past doesn't mean it will work now. Markets are seasonal and conditions can vary from year to year. In more technical terms, past data may not always reflect the current environment. This is why paper trading afterwards is so important. It allows you to test your strategy live without real risk to make sure it's still viable. Finally, I want to talk about hedging. Hedging is another powerful technique that can help protect your portfolio and reduce emotional stress, especially during volatile markets. Hedging is essentially placing trades that offset potential losses in your main positions. This can soften the blow if the market moves against you. For example, if you hold long positions in tech stock and the market seems overheated, you can hedge by buying put options or shorting an index that mirrors your portfolio. This way, if the market drops, the gains from the hedge may help balance out losses in the long position. The same applies if you're short an asset or the market. You can hedge by buying call options to protect against sudden upward moves. Hedging isn't about eliminating risk entirely. It's about managing overall risk and ensuring that a single market move doesn't cause major damage to your account. Even small hedges can help provide peace of mind, allowing you to stay calm and stick to your trading plan without reacting impulsively to market swings. Later in the video, I'll walk you through a personal example from earlier in my trading career, where I let my emotions drive my decision. I'll compare that to a more recent scenario during one of the biggest market sell-offs we've seen recently on an FOMC day. By using hedging, I was able to protect my portfolio and avoid significant losses while the market dropped sharply. This example will show how powerful these techniques can be when the market turns against you. I recommend exploring simple hedging strategies, even if you're just starting out. It's an essential skill that can protect you during uncertain times and make you more resilient trader. By combining these strategies, journaling, taking break, following the 3-strike rule, paper trading, backtesting, and hedging, you build a solid foundation for emotional control and long-term trading success. Before I wrap up this video, I want to share 2 examples from my trading career to show how far I've come mentally and emotionally. A few years ago, I decided to try day trading futures. Back in 2023, market volatility was high, and I thought, well, if I can just figure out the direction of the market for the day, I can make a lot of money trading futures since they are leveraged, famous last words. At first, I was trading small. I would either make or lose a few $100s per trade. Nothing too exciting. But that wasn't enough for me, so naturally, I decided to raise the stakes. One day, more specifically March 22nd of 2023, I shorted Nasdaq futures NQ about half an hour before the FOMC announcement and roughly about an hour before Powell's speech. Yes, looking back, this was a dumb decision. When the FOMC statement was released, the market barely ticked down, but then it rallied hard, making new daily highs. I panicked and covered my short positions for a loss. At that point, my rational brain had left the chat. Frustrated and emotional, I thought, forget it. Let's flip this trade. The market is clearly going up. So I went long. Then Powell took the mic. The market didn't just dip, it fell off the cliff. I sat there, wide-eyed, watching my account bleed as I realized I had no stop loss, no profit target, and no plan, just pure, unfiltered panic. By the time I closed the trade, I had taken even bigger loss. In total, I lost over $11,000 in a single day. Not because the market was unpredictable. Oh no, because I let fear, greed, and frustration take over me. I didn't have a trading plan, no stop loss, no profit target. I just traded on pure emotion and what I thought was going to happen. Had I applied even a few basic risk management strategies, I could have minimized the damage or at least limited the bleeding. If I'm being honest, this wasn't even trading. This was straight up gambling. And like always, the house won. Now let's fast forward to a more recent FOMC meeting on December 18th, 2024. The markets sold off sharply during Powell's speech, one of the biggest market drops we've seen on an FOMC day recently. I knew the sell-off could happen because the market had been rallying non-stop for months and the risk to the downside was getting harder to ignore. But this time, I was ready. I had been building hedges in the days and weeks leading up to the meeting. And to play it safe, I also bought put options on triple Qs with the same week expiration, just in case things got really ugly. Unlike before, I wasn't guessing. I knew exactly how much I was willing to risk, where my stop loss was, and what my targets were. Sure enough, the market dropped hard. My long-term positions took a hit, but I didn't panic because I knew my hedges were in place. Some of those hedges were up 400 to 500%, while others brought in solid double-digit gains. Even though the S&P 500 and Nasdaq were down nearly 4% by the end of the day, my portfolio was actually up by almost 5%. There are 2 things that you should take away from this. First is to always stay calm under pressure. Seriously, don't let every little market move throw you off. Trust your plan and stick to it. Second, hedge your positions. This doesn't mean predicting every move, but having hedges in place can protect your portfolio from big sell-offs like this one. It makes a massive difference, not just financially, but emotionally. There are plenty of ways to hedge. If you're long on a stock or asset, you can buy put options, sell covered calls, short indexes, or use inverse ETFs. Hedges don't eliminate risk, but they soften the blow and help you sleep better at night when things get volatile. This is why I keep saying risk management and trading psychology go hand in hand. You can't separate them. If you ignore one, then the market will remind you, and it won't be cheap. I'll wrap it up here because if I go any deeper into hedging and risk management, we'll be here all day. Alright, let's do a quick recap of what we have covered today. The first thing to remember is to acknowledge your emotions when trading. Don't try to ignore them, but don't let them control your decisions either. Just being aware of them is half the battle. Next, write down your trading rules and stick to them. No exceptions. Having a solid plan takes the guesswork out of the trading and keeps you from making impulsive decisions. Make sure you're protecting your trades with stop losses, proper position sizing, and yes, hedging. The risk management strategies we covered will help you create a safety net, so you're not reacting emotionally every time the market moves against you. Discipline is everything. Without it, no strategy, indicator, or fancy tool is going to make you consistently profitable. And as you go, track your progress. Look look back at your trade, see what's working, and adjust as needed. I would love to hear from you. So if you've got experiences or tips to share, drop them in the comment. And if you have any questions, feel free to ask. I'll do my best to answer them. If this video helped you out, hit the like button and subscribe. It really helps the channel grow and lets me keep making content like this for you. Thanks for watching, and I'll see you in the next one.